Welcome to Blindspot. I'm Steve Reardon. Today's show is co-hosted by my colleague and cryptocurrency enthusiast David Lawant. We are happy to have as our guest this week Peter van Valkenburg on the line from Washington, D.C. Peter is the Director of Research at Coin Center. Based in D.C., Coin Center is the leading non-profit research and advocacy center focused on the public policy issues facing cryptocurrency and decentralized computing technologies like Bitcoin and Ethereum. He has a JD from NYU and is a 2013 Google Policy Fellow. He writes about how legal theory can help us understand the development of self-regulation and self-governance within online communities and how network technologies can improve traditional legal systems. Peter, welcome to Blindspot. So I want to talk a little bit about kind of cryptocurrencies and Bitcoin today. I think one thing I just want to emphasize for our listeners is we're not going to spend a lot of time going through kind of what they are, but I'm going to post a bunch of resources that are on the Coin Center website. So if anyone wants to kind of do an intro course on crypto, they're welcome to do it. But Peter, for you, just to kind of get us orientated, what is your kind of view on the current state of the industry at the moment?
Sure. So it's an interesting time to actually think about that. It just occurs to me that given it's 2017, we're coming up pretty close to the decade anniversary of Bitcoin's creation. So the white paper that Satoshi Nakamoto published was in late 2008, and then the network went live in January of 2009. And so we've had this decentralized payments system or cryptocurrency for quite some time now. And I think a lot of people who have been watching it sort of casually, but not really involved with it, might be thinking, it's really sort of, all the fire's gone out. It didn't catch on. I think people get impatient about these technologies and don't necessarily realize that what we're talking about when we're talking about either Bitcoin or Ethereum, which is of course a follow-on invention that builds a lot of, new features onto the same technology or technological constructs.
Yeah.
We're talking about a fundamental internet protocol, potentially, something that will really revolutionize the way we communicate with people, the way we have commerce with other people globally, and the way we actually come to do any kind of trust necessary group computing with other people across the world. And when I mean trust necessary group computing, that's my awkward sort of off the cuff phrase for what doesn't have really a good name for it right now, because it is something new. The idea that we could engage with effectively a perfect stranger across the world in some sort of trustworthy relationship. Now that could mean they present me with an identity credential, and I'm obliged and feel comfortable believing what that identity credential warrants about that person. You know, maybe they have a credit score of this, or they have a bank account that's like this, or they have this much cryptocurrency to their name or in their control. And we can do that using just a protocol rather than having centralized institutions like banks, governments, nonprofits be the arbiter for that trust. We could just do it like we can just right now do a podcast over the internet.
Right.
That's a radical thing, and that's a thing that's going to take time. So a lot of the adoption has been slow. There's been very slow consumer adoption of Bitcoin, for example. Like I can't go down to the bodega outside my apartment here in DC and buy, a 6-pack of beer for Bitcoin. There's a few places in the world where you can have a face-to-face transaction with Bitcoin, but not many, because merchants don't want to take it, because customers don't usually have it. So why bother? But having pipes basically on the internet, those kinds of transactions, that's something that really is revolutionary, and that's something that will become a foundational level of a lot of internet systems as we go forward, I think.
I mean, it's an interesting idea that you present. It's because I think one of the concerns, especially here in the Valley, is if you don't get something that gets sort of mass adoption or quick user growth, right, it just kind of peters out and doesn't go anywhere. So is it that our kind of models for how tech should be adopted or should grow are wrong, or it's just kind of Bitcoin and crypto and kind of the blockchain is just a different kind of technology that's always going to take longer?
I think our models might be a little bit wrong, considering that our models are based on a way of looking for value and valuable new technologies that was built on all of the innovation and value being the layer built on top of the protocol, the application layer.
Right.
So the internet is just TCP/IP and HTTP and a series of protocols that allow us to do a lot of things. And that is fantastic and amazing. But most of what we think about when we think about the internet are the layers, the application layers that have been built on top. So Facebook, Twitter. And that's where we see, maybe not so much Twitter lately, but that's where we see people speculate as to the value of these things.
Right.
Say, oh, look at all the users that this thing has gotten
Right.
at this application layer. Now with Bitcoin or with Ethereum, we're not talking about the value existing so much at the application layer. We're talking about the value actually existing at the protocol level. And that was not something that was possible back with, say, TCP/IP, because the protocol level is just open source software being run on computers all over the world. Now, with Bitcoin or Ethereum, the protocol level is, again, just software that's open source being run on computers all over the world. But there's something very special about the software now, is that it is capable of describing a ledger which can authoritatively have a scarce token and its value denominated as far as just it being a scarce item and different people having allocations of it. So you can actually have that value baked into the lower level protocol, which is a rather radical different economic model and business model, if you will, than previous technological innovations in the internet that we're familiar with. So it does make it possibly harder to figure out exactly what's going on, where the value is, where people are speculating as to the likelihood that something will be a killer app or not, because we're talking about an economic system being. Did that just get picked up?
Yeah, it's fine. It's not an issue.
That was my Google Home. I'm going to mute it and come right back. I've obviously bought into the connected devices.
Yeah, it looks like it. I'm a little bit disappointed. I was hoping to speak to the cryptocurrency guy that was in the padded room that told me that I had to get onto some crazy Tor network to be able to speak to you. But, you actually look semi-normal and in a connected home in DC.
Yeah, no. So I've got my router set up with a VPN for the whole house. But it does lower the bandwidth significantly.
Right.
So let me see if I can catch back up to where I was. Because you have a lot of value baked into the protocol layer rather than it being in the application layer, I think you're looking at a different sort of economic landscape and marketing landscape than you had with previous innovations. So that is one part of it. And also, just as far as the slowness of the technology being picked up by people, I think when the protocols that we now rely on for, say, this voice call were being developed and all of the internet were being developed, most people were completely ignorant about them, the vast majority of people. So we're talking about the development of TCP/IP. We're talking about the 1980s. And it took a long time before those internet protocols, as valuable as they were then, but it took a long time before ordinary people would use them to do things throughout their day. And ultimately, those protocols only caught on once people didn't even realize they were using them. Your grandmother has no idea what TCP/IP is, but she can see pictures of you and your family.
I just want to ask something, and it's just related. David's got a really good question, but I want to ask something related to kind of protocols. I spent some time with Naval Ravikant, a couple of months ago, and he has this idea about the blockchain being fundamentally different because it allows you to monetize protocols for the first time in history. And he had this idea that essentially the whole internet is built off these free protocols. And if anyone had figured out a way to monetize it, they'd be the richest person on the planet at the moment. So can you I haven't quite been able to wrap my mind around that, but maybe you can sort of unpack that for me and how that's different to kind of what's happened so far.
Sure. So the other person I've heard talk about this a lot is Nick Grossman at Union Square Ventures. And I like Nick's model personally because he calls it fat protocols. And he just has a simple graphic to explain it, where you see the value in the internet is this thin pancake, which is the protocol, the value of the protocol,
yeah.
TCP/IP, and this fat pancake on top of it, which is the application layer. And that's what Facebook, Twitter, what we were talking about earlier, that's where they come in. And then in theory, with blockchain protocols, you can invert that. And the thin pancake is the application layer on top.
Right.
It's, my blockchain.info wallet is basically just software running on my device. And the company blockchain.info, they have a good business model. But they only make a modest amount of money off of advertising attached to people using their wallet product. They're not holding a bunch of funds for people. They're not holding a bunch of consumer data about people. They're very different than Facebook or God forbid, an online bank.
Yeah.
And most of the value of that system that they provide access to, and most of the functionality is all in the protocol layer, is in the blockchain, which keeps a record of all of the Bitcoin transactions, is in the network of nodes on the Bitcoin network across the world that relay the transactions. So most of the functionality and value is in that protocol layer, which was very stripped down in the internet context.
Right.
And very little is in the application layer, the blockchain.info wallet, which was incredibly expanded in the internet context, where Facebook is basically doing all kinds of things layered on top of TCP/IP.
That's very interesting.
Hi, Peter. It's David here. Hi. This is all very interesting. I'm just going to switch gears a little bit, still keeping on the Bitcoin theme. So today there's a lot of discussion about whether Bitcoin is a medium of exchange or a store of value. So in your opinion, is it a currency, a commodity, a payment system, a little bit of both, a little bit of all? What do you think about it?
I mean, so when you phrase it like that, you get into sort of metaphysical questions about what even is money. So the three classical...
There we are. I knew it would come out.
The three classical attributes, according to Austrian economics and economics generally, are a medium of exchange, a unit of account, and a store of value. Here that money has to exhibit all three to be called money, or to be called currency, basically. But I will say that Bitcoin, for example, is a terrible unit of account because its value is so volatile as compared to other currencies. So even the online commerce sites where you see people selling computers for Bitcoin or something like that, you usually still quote prices in local currency, because if you had to figure out whether the GTX 1080 graphics card you really wanted to buy is worth it at a price of like 0.75 Bitcoin, you're just going to, it's transaction costs, and the kind of transaction costs that are deadly to any economic system, even if it's got something cool like Bitcoin underlying it. So it's bad unit of account. Medium exchange generally has to do with whether everyone's willing to take it, right? I mean, so this is the so-called, the fabled answer to the barter problem. I have oranges, you have apples, but I want apples, but you don't want my oranges. You want passion fruit. So we need some sort of mutually shared desire for something in order to have effective, efficient commerce. We need a medium of exchange. And Bitcoin's not really great at that either, quite frankly, at the moment, because most people aren't aware of its value, willing to figure out how to accept it as a medium of exchange, as payment for something, and then aware of how they can then use it to buy something else. So playing that intermediary role in any economic transactions, it's not great at right now. And then store of value, that's probably where Bitcoin has excelled most. And this is all relative, but excelled most in recent years. So I think, I don't know the statistics exactly off the top of my head, but something like 4 of the last 5 years, and probably goes back further, Bitcoin was the best performing currency asset as far as its appreciation and value. But it's not a stable store of value. It behaves more like a speculative venture capital investment. Like we'll have 1 year, 2013, where the value will spike up and then collapse, basically. We'll have other years where it's generally on an up and to the right trajectory. But quite often you're talking returns of something like 10, 20, 30%. So not the kind of returns you'd expect from a normal securities investment, let alone a foreign currency investment, which you would expect very modest returns or possible losses. So the whole package of Bitcoin then as an economic good is kind of a weird one. And as I said, I think it most resembles a speculative investment in a venture capital startup. And I think that's right, because basically, you're talking about a technology that has potentially massive value as a currency and as a network for creating a single source of truth for any number of other trust necessary applications. But you have very few people using it right now. And so you have the potential for an exponential growth curve, and you have a static supply. There's only ever going to be 21 million Bitcoins. So you take a flat line and you intersect it with a exponentially increasing line, and you get the potential for wild growth. But that is just potential too. It's still early days. We have a bit of a format war. It might turn out that follow-on innovations built on top of the Bitcoin technology or built using similar technologies might catch on instead of Bitcoin, or they might catch on in tandem. And some of those are things like Ethereum, Zcash. So from an economic standpoint, I think it's still an open question as to what Bitcoin will become. And it's an amazing thing to watch, basically. And as Naval said, if you could monetize the internet and literally have a unit of value for every TCP/IP transmission that happened, you would be the richest man alive today. But if you also bought an investment into every transmission of X25, the other packet switching network, you would not be very rich right now.
And Peter, what do you think about the, let's say, disproportionate role of China, both in mining activity and in trading volumes, at least until recently? There were some recent changes there, right?
Sure. So China is very interesting, and it's a bit of a black box. I'm not going to pretend to know with any authority how either the Chinese government or people in mainland China truly feel about these technologies and why they're doing what they're doing. But I will say that there's a few things there's two things you mentioned. There's two things that China definitely does have a pretty strong grasp on. And that's mining. There's a lot of Bitcoin mining going on in China, not the government, but, private individuals. And then there is a fair amount of exchange volume, until recently, when basically the Chinese banking regulator came in and said, you need to charge fees for transactions and limit your margin trading activity, which definitely cooled off some of the exchange activity. So I think the margin trading and the exchange activity generally is a lot of speculative investment from people in China who see this as a possible new global economic system and something they want to get involved with and play with. And given that until recently those exchanges were fairly unregulated, you could do a lot of high-speed trading to sort of to earn money off of the arbitrage between different exchange rates on different exchanges. And if those exchanges aren't charging fees, then that's, I think, a lot of what the volume was. There's also rumors that the exchanges were actually artificially inflating their volume numbers with wash trades in order to appear, like we're the big Bitcoin exchange, and get customers that way. And then with mining, I think mining's actually more interesting than the exchange story in China, because mining's an interesting topic that you could spend a whole podcast talking about in itself. But the bottom line is, miners do two things. They listen for valid incoming transactions from the entire peer-to-peer network. They bundle into blocks, and then they solve this difficult math problem in order to have the privilege on the network of writing the next block to the blockchain. And for that, if they do those two things successfully, they get a reward of brand new Bitcoins and any transaction fees that were appended to transactions during the period of time when they wrote the block, which is about a 10-minute period of time. The long and short of it is you need a lot of computing hardware that's quite powerful with a very specific use case in mind, which is solving the SHA-256 hashing algorithm, which is that problem they need to solve. And they need a lot of electricity to power that hardware. So you need cheap and high-quality silicon, which is designed to do something very specific. You need basically application-specific integrated circuits, or ASIC chips, which do nothing but solve SHA-256 to be the most efficient at solving SHA-256. Like my laptop can solve SHA-256, but much less efficiently. And you need a lot of cheap electricity to power all those chips that you've put in. And chips and hydroelectric power are two things that you find in abundance in especially inland China. And there's always rumors about, so it might just be that the economic returns to scale are quite good for Chinese miners. And it might also be a little bit of what you might call sort of corruption or just a opportunistic government and private sector collaboration. There's always rumors that basically China has these massive infrastructure projects. They've built hydroelectric over the country for cities that would be populated with millions, but which didn't really grow at the rate that the government expected them to grow when they had the infrastructure project planned. And so you've got this hydroelectric power plant that's just going unused, and a local government official who'd love to make some money off of all this spare electricity in their district. And so they collaborate with a local individual who wants to start a Bitcoin mining operation. They get free electricity to run their Bitcoin mining operation, and the local official gets a cut of the Bitcoin, basically. This is the rumor. I have no ability to confirm the validity of that rumor, although it sounds like a pretty good deal. And it actually sounds surprisingly like an efficient economic outcome. If they were going to build that hydroelectric power plant anyway, and if the city that was supposed to be powered by it never materialized, then you might as well do something with it. And what they're doing, what a Bitcoin miner is doing, is providing global infrastructure for payments and for cryptocurrency, which is great. It's a public good. So China might be financing a public good right now, which is kind of cool.
Yeah. So Peter, I mean, we touched on it there in your answer a little bit, but I want to speak more broadly about kind of regulation and how you guys think about it. The cryptocurrency industry more generally has attracted a lot of, I guess, libertarian thinkers and people who had this idea that there would be no regulation in this new industry. How do you guys think about it, and how do you respond to people who say that, they want this thing to be completely open and unregulated?
So the funny thing about any technology is no matter how novel and interesting it is, technology is just a tool to allow people to do different activities. A hammer is a tool to allow you to do nail hammering activities. A computer is a tool to allow you to do communication activities. And Bitcoin is a tool to allow you to do money-related activities, whether it's paying somebody, getting paid, storing value, all these sorts of things. And regulators, they don't regulate technologies generally. And when they do, they come up against a lot of opposition from libertarians and, people like us, people like the EFF, because we don't think technologies should be regulated. We should regulate activities, potentially, if there's a compelling case to regulate an activity because there's a risk of harm to consumers or there's a risk to the economy, things like that. And so when Bitcoin came around, basically, there's never been a point when Bitcoin wasn't regulated. That's one of the things that's hard for people who aren't trained in the law or regulation to understand is states in the U.S., for example, have always regulated money transmission. And they have very broad definitions of money transmission and what qualifies as money transmission. And they regulate it to make sure that when, a down on your luck person goes into a Western Union and tries to send money to a friend, that they don't end up paying an obscene fee or having that money lost because the company wasn't even a legitimate company.
Right.
So when you do these same things with Bitcoin, if I go to a Bitcoin ATM and put some dollars in and get some Bitcoin out and then use the software that the ATM provider recommends on my phone to send those Bitcoins to my friend, that's probably going to fit the definition of money transmission in a lot of states. And so by virtue of that, Bitcoin's always been regulated. And that's just on the consumer protection front. So in the U.S., we also have questions of financial surveillance, basically under Bank Secrecy Act regulation, which is when a financial institution needs to report things about their customers to the government because a transaction is suspicious or it's over a certain dollar value. These rules all are amenable to being applied to activities performed using Bitcoin. They're drafted broadly and they describe activities. If you are an intermediary in a transaction and you help someone send this much money to someone else, if it's over $10,000, you have to file a currency transaction report. That's just what you have to do. So this might seem like I've gone off on a tangent to your question. Your question is, what do you say to the people who say it shouldn't be regulated? The first thing I want to say is, then that's a political debate that we need to have. It doesn't just extend to Bitcoin. It's a political debate about regulation in general.
Right.
It's not as if people are stepping in and saying, we're going to regulate Bitcoin. The things you do with Bitcoin were already regulated.
Right. So
now,
you already have
lobby the government to say, let's not regulate it,
right.
Then we should do that. But we're not starting from a basis where there's nothing and people are coming in trying to take a part of it.
Right.
They've already got a part of it. And why exempt Coinbase, which holds people's Bitcoin, from money transmission regulation if you're not going to exempt PayPal, if you're not going to exempt Western Union? Now, we should probably have a conversation whether money transmission regulation and licensing at the state level is a good way of doing consumer protection, whether it's PayPal, Coinbase, or anything else. But that's apart from a conversation about whether Bitcoin should be regulated. Already is.
That's cool. So, Peter, you touched on the legal framework for Bitcoin companies to act as money transmitters, and that apparently varies significantly across states. In New York, yes. I believe there's a concept of the bit license. In California, there was a proposal for a digital currency bill that was not implemented or not approved. Which model do you think is the best one? Which state applies the best model in your view?
So personally, I like the states that have taken a really humble approach to this and said, actually, according to our current laws, Bitcoin does not qualify as money for money transmission. There are a few states that had laws that were amenable to that interpretation and have taken that interpretation formally by issuing guidance to clarify that that's how it works. This Kansas, and most recently, as of 2 months ago, Illinois, which is in the process of finalizing guidance that would specify that. Now, that doesn't mean that in those states, a company like Coinbase wouldn't necessarily need to get a money transmission license, because Coinbase will take dollars, or Circle will take dollars. A lot of the Bitcoin exchanges will take dollars and convert them into Bitcoins. And that moment where they hold your dollars is a moment where they're a money transmitter. So what it does mean is if you have a completely digital business, something like maybe what Shapeshift does, where they exchange altcoins for other altcoins, or if you could imagine a hosted wallet provider who did not also have an exchange. I can't actually think of any, because most of the hosted wallet providers do also offer exchanges. But if it was a purely Bitcoin business, you're not regulated. And I think that's a wise approach, because these technologies are new and different, and there are new and different considerations for regulators to make sure that customers are safe, to make sure that everything's working as it should. And squeezing those regulatory policy goals into existing regulatory structures like your legacy money transmission regulation doesn't quite make sense. And then you have other states that have said even pure Bitcoin activities are money transmission. And those are states like North Carolina, New Hampshire, Washington State is right now most recently going through this process of saying that even if you were just dealing with other people's Bitcoins on their behalf, you're a money transmitter. And then there's a third category of states, like, as you mentioned, New York State and California, which want to create structures that are very similar to the money transmission licensing regulation, but make it a different but similar structure specifically for virtual currency or digital currency companies. And that's the BIT license in New York, which was done at the regulatory level, and then the legislation that has stalled in California, which would have created a similar parallel licensing regime. So you have your money transmission licensing regime, and then if you are a virtual currency business, you have a virtual currency licensing regime. And that can either be good or bad. In the case of the BIT license, we generally think it was actually fairly bad, because that statute, or it's not a statute, it's a regulation. That regulation was drafted in a sort of slipshod fashion, and a lot of the language is too broad, too open to questionable interpretations, too amenable to requiring that even non-custodial Bitcoin businesses, like people who are developing new cryptocurrencies, people who are offering software wallets rather than actually holding Bitcoins for people, might be treated as money transmitters or, virtual currency businesses that need to be licensed. And that's really a big problem, I think, because these people, they're not holding other people's funds. So we don't need to do the sort of prudential and consumer protection regulation to make sure their customers are safe, because they're not holding funds on behalf of their customers. So that's the big problem with the BIT license. In California, there was one bill that we did like, which was much more circumscribed than the BIT license, would have only covered truly custodial hosted wallet providers in the licensing regime, which is fine. If you're going to license PayPal, then it makes sense to license someone who's holding your Bitcoin for you. But then there was another bill that got substituted for that first bill that was much broader again. So we actually started advocating against it. And fortunately, that second bill didn't make any headway. So we're back to the drawing board in California.
So, Peter, I want to just touch on this idea of kind of exchange hacks that have come about over the last couple of years. I think for most people on the street, there is this weird contradiction with Bitcoin where there are experts saying all the time about how incredibly secure this thing is, and yet they open the New York Times, the Washington Post, and they hear that, X amount of millions of Bitcoins have been stolen. So can you kind of parse out the difference between the exchanges and the underlying technology, I guess, is point one. And then as sort of advocates in the industry, how do you improve that to the point where you can actually, I guess, sell Bitcoin or sell the concept of Bitcoin or cryptocurrencies on their idea of security?
So it is confusing, I think, to your average person reading Wired or something, right? Where somebody is writing about how Bitcoin is this unhackable system. Yeah. And then you hear stories about Mt. Gox, of course, but also Bitfinex more recently, losing tons of customer money. And the fundamental thing to keep in mind is there are two security structures involved in this conversation. There is a blockchain which records basically who has which Bitcoins, and it doesn't record names. My Bitcoins are on the blockchain just like all other Bitcoins, but they're under a pseudonym, so they're under a public address, which is the one half of a public-private key pair, and basically, because I possess the private key, I can make transactions on the network that will move those Bitcoins to somebody else's Bitcoin address. And that blockchain you can think of as a sort of fiduciary structure. It's a data structure that describes who has what. And if you were to make changes to that data structure, you'd be talking about changing who owns which Bitcoin. Now, what we're saying when Bitcoin has never been hacked is that data structure, the blockchain, has never been systematically reorganized by people who were not authorized to reorganize it. So I can write transactions that deal with the Bitcoins in my public address because I sign a transaction with a private key. I move my Bitcoins. There are no large-scale cases, no real cases at all of anybody systematically moving other people's Bitcoins without them signing a transaction with their private key. Now, when an exchange gets hacked, you're talking about a company, not a network, not a blockchain, not a peer-to-peer network. You're talking about a company who's taken it upon themselves as a business to hold a bunch of people's private keys, which therefore empowers the company to make transactions on the peer-to-peer network with those customers' Bitcoins. Now, what they're doing is quite simply keeping a big SQL database of a bunch of private keys that are linked to public addresses that have Bitcoins in them. And as with any, valuable data, that data can be compromised, the company can be hacked, and people can get a hold of that sensitive data. And what that means in the Bitcoin context is if you can hack a company that's holding a bunch of Bitcoin for other people and get their private keys, you can write transactions from all of their customers' accounts on the peer-to-peer network and move money. So you're talking about a pretty simple data security problem. Now, then you have this question, all right, how do we make the system better? So there's a few things. Exchanges can be better about their data security techniques, and there's a few things there like multi-sig keys, cold storage, so basically making sure that any piece of writable media that has the keys stored on them is not connected to the internet, where it would be potentially vulnerable to hacking. But the long-term evolution of these systems, I don't think involves companies holding a bunch of keys for their customers, because that is a honeypot. It's this vulnerable choke point where if the company gets hacked, a whole bunch of people will lose their Bitcoins. I think the long-term evolution should be individuals holding their own Bitcoins. Now, that's got some problems of its own, no doubt, and there's plenty of people who have held their own Bitcoins who have lost them because of hacking when they privately were hacked. But there's a few different incentives here. So if a company's holding a whole bunch of Bitcoins for a whole bunch of customers, then that's a big target.
Right.
Me, I don't have that much Bitcoin. I've got some. So it doesn't make sense to spend a lot of resources trying to hack me, you know? Whereas if you're talking about a company that holds Bitcoin for thousands of people, you're talking about a much bigger payoff if you can compromise that entity versus just compromise me as one person holding his own Bitcoin. The other factor here is making user-hosted wallets. So me hosting my own wallet, making the software that enables an individual to host their wallet so good that it's harder for the user to screw up.
Right.
Because, you know, if I host my own wallet and I don't even need to get hacked, I could just lose my USB thumb drive or lose my cell phone or wherever I've kept the keys, and then I've lost my money myself.
Right.
So there needs to be better user interfaces that help the user say, okay, you want to hold Bitcoins? I'm going to give you the software app on your phone, but when you sign up on the software app, it's going to make sure it's only going to let you start receiving Bitcoins at this address after you've backed up your wallet to a USB thumb drive. It recommends where you store that. It might say impanel or empower 3 of your closest friends to be able to re-provision your keys for you. So you can do multi-signature transactions and set up wallets potentially wherein I'd have a wallet on my phone and that would have one private key on it. I'd have another key that I keep in my sock drawer, and there'd be a third key that I give to my friend Adam. And basically I say, Adam, put this in a safe place. Don't lose it. I might need it one day if I lose any of my keys. Now, if I lose my phone, so by the way, the part I missed is that in order to transact on the Bitcoin blockchain with this particular key setup, you need 2 out of 3 keys to sign a transaction. So if I lose my phone, I can't, I don't have to worry, basically. I can get the funds out of that account by digging my key out of my dresser drawer and calling up my friend Adam. And then the 2 of us sign a transaction that move funds to a new address that I have provisioned on my brand new phone. So this is just one example. There's much better and more complicated potential structures that you could come up with this multi-sig key storage solution that would make it difficult for a user to screw up their own storage of their own keys and make it therefore safer to have Bitcoin because you don't have to worry about trusting a big company to not get hacked. You have your own keys on your device. Your friend has their own keys on their device. And basically you have systems in place such that if you were to ever lose your device, you could easily re-provision keys onto a new device. The idea is just to move security in this network infrastructure to the edges rather than having it at centralized choke points or at weak points. And this principle extends not just to holding Bitcoin, it extends to all kinds of things. So I wrote an opinion piece in Wired not long ago that discussed the DIN, distributed denial of service hack that brought down a lot of prominent websites here in North America for a few hours, not too many months ago. Basically, the problem you had in that scenario was, again, you had one centralized intermediary, DIN, which is a DNS provider, that got hacked. And when their servers went down, if you typed in reddit.com, your web browser wouldn't be able to resolve that to the IP address that is Reddit servers because DIN is the one who did that address lookup and DIN's servers were down. So the problem there is that we have security in this model and availability of data. We have it in the center of the network infrastructure as opposed to it being at the edges. So we could do DNS at the edges. It would look a lot like Bitcoin, wherein the record of whether reddit.com resolves to 192.168.1.1, the IP address, the record is not kept by a centralized intermediary like DIN. It is kept on my device redundantly along with every other device on the peer-to-peer network. And so there is no single point of failure. There's no way for somebody to be hacked in that case. We have a much more resilient infrastructure from a cybersecurity standpoint because security has been moved to the edges and massively decentralized rather than relying on a few big companies to maintain our security and our network infrastructure.
Peter, we could talk about this for hours, but unfortunately we're running out of time. This is extremely interesting. So I'm going to make the last question. And it is about political support. So how is the support or rejection of cryptocurrencies in the political spectrum? And on top of that, what's your opinion about the new administration, how they think about cryptocurrencies?
Sure. So the best thing about cryptocurrency from my perspective, as somebody who has to work in regulation and policy, is that it's a nonpartisan issue. For the moment. Now, that may change at some point in the future. We certainly hope it never changes. But there's precedent for this as well. Before cryptocurrency, an interesting political issue that was nonpartisan and technological was intellectual property, where you had both Democrats and Republicans having reasonable disagreements amongst themselves about, how much can we enforce copyright on the internet? It doesn't always make sense to enforce copyright the same way we did with books on the internet because it's so easy to copy everything. And you saw Republicans who took different viewpoints. You saw Democrats who took different viewpoints. Doesn't mean we always got good policy, but we got compromise. And we got the Digital Millennium Copyright Act, which has the safe harbor provisions, which allow a company like Google to not be sued constantly for copyright infringement whenever someone uploads a copyrighted video to YouTube. We actually expect that similar compromise will generally be available in the Bitcoin space because you have Democrats who are interested in this technology. For example, Congressman Jared Polis in the U.S. House of Representatives, and Republicans who are enthusiastic about this technology. For example, Congressman Schweikert, also from the U.S. House of Representatives. And those two congressmen actually just announced the creation of the Blockchain Caucus. So it's a caucus is a group of legislators who will get together and discuss and learn about these technologies and try and come up with policy that will encourage innovation in these technologies, policy that will allow America to be a welcoming home for companies in this space. I think there's a lot of pressure to actually get this right because everybody has, at least almost everybody, has now come to realize that the internet was a massive boon to the American economy.
Yeah.
And the way there, and it would be a shame if we couldn't be a leader in the next wave of technological innovation. And yet our regulatory systems are not as friendly, maybe as, say, Switzerland's or the UK or Singapore right now when it comes to doing new technologies that deal with cryptocurrencies. So I think there is actually a fair amount of political will to get it right. And I think that extends even to the new administration. We see that Trump is generally deregulatory, which can be good, but of course he may not be the biggest advocate for civil liberties, which could be bad for this technology. So it's a wash, and we'll see what happens.
Peter, thank you so much for coming on Blindspot. It was really, really interesting, and we loved it. Thank you.
Thank you for having me.